And then what does that mean for a company? Well, you know, it means you should put your cash reserves in Bitcoin, because you're not going to, it's very, very hard. Very few companies over the long term have even come close to keeping up with Bitcoin, because the historic rise has been so meteoric, and we all know the metrics of the history, right? Best performing asset class of the last 15 years, 10 years, 5 years, pick anything you want, right? I mean, very short term, not so much, because you've got macro volatility, market drawdowns in the cycle, but any kind of 8 year, 10 year, 12, 15, it's just clearly being everything.
What's the smartest thing a company can do with its idle cash? Most CFOs would say, keep it safe, maybe park it in short-term bonds or a money market fund. But what if playing it safe is actually the riskiest move of all? In a world where fiat currencies constantly lose value and inflation quietly eats into balance sheets, holding cash might be the slowest path to bankruptcy. That's the curveball this conversation throws, and it lands hard. Popular British cryptographer and Bitcoin analyst Adam Back doesn't tiptoe around it. He makes the case that Bitcoin isn't just some speculative asset anymore, it's a benchmark. When you look at the long-term charts, it's not even close. Bitcoin has smoked every other asset class over 8, 10, even 15-year periods. And while short-term volatility might scare off the timid, the real danger lies in standing still. If you're a company watching your reserves slowly devalue, you're not being conservative, you're bleeding. That's the crux of Back's argument. Most companies aren't failing because they take big risks. They fail because they avoid bold decisions entirely. Bitcoin, with all its noise and cycles, represents clarity in a fogged-up world. It's not about chasing hype. It's about preserving value in an era where everything else quietly loses it. Let's watch highlights from Adam Back's sharp market analysis to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
I mean, my initial reason actually was, of course, Michael Saylor was the pioneer, and nobody followed him, to my surprise, for quite a few years, right? They started running annual seminar days for company execs to provide the playbook and the accounting and all the factors that went into enabling them to do it, to help other public companies do it. And it took a surprising number of years before any other public company entered the space, actually. So that was a little bit surprising to me. But once Michael Saylor started doing it, I thought, this is, Bitcoin's got a lot of mission-oriented stuff in it, right? People are going out of their way to, explain Bitcoin to extended friends and family, people they encounter, and it doesn't do them any direct good, but they want everybody to enjoy Bitcoin and benefit from it, right? So I thought what MicroStrategy was doing, was a useful new track on that, right? So he hit on the idea of a company using Bitcoin as a, in a period of high inflation and quantitative easing, as a way to protect their cash reserves from inflation. I think it's purely defensive, and he's been, very transparent and talked at great lengths about the thought process along the way. So you can kind of, if you listen in, read some stuff, listen to some videos over the time, you can get a quite clear picture of the thought process that got him into Bitcoin at all in the first place, right? Because his resolution to buy Bitcoin personally and then work through the process of buying it in the company was his first entry into Bitcoin. It wasn't like an old, a person who's been in Bitcoin for years. And that was really because of the, as defensive as you say, because of the COVID era, whereas enormous amounts of quantitative easing, the interest rates were pushed to super low. And, for anybody kind of looking at investments, of course, you're aware of the asset price inflation, and, you'll have a view on whether the government official inflation metrics match reality. And there are independent organizations that try to, Trueflation and things that try to put a number on it. But it depends what you're talking about. It depends if you're talking about, the average person's basket of expenditure, or if you're talking about sort of savings type money and things you might want to buy with that, like real estate, right? So if you're talking about that, I think the inflation rate's even higher. And that's the area that Saylor is focused on, because operating market strategy for a great many years in the business intelligence sector, and I think he might actually be the longest like continuous public market CEO in the US or something, right? Because he
I think so.
became
Yeah.
a public company CEO at a kind of interesting story when he's pretty young, which I'm sure people can find if they look around for it. But anyway, so he had five. I think the company metrics at the time, its market cap going back a few years before they got into Bitcoin, varied between 1 and 2 billion. They had, I don't know, I think something like 500 million revenue. They had 500 million cash reserves, and it's like 1,700 staff, something like that. You'd have to look on their website, and 500 million cash reserves. To get them through market cycles, to fund new product initiatives or pivot. So I think they have a kind of web transition now, right, where they're trying to do more web and then they're trying to do AI. So it's continuously evolving, this kind of business, right, to keep up with the times and what people expect. So they've got to have a cash reserve to get through market conditions and to take product initiatives that are bold. And so he got pretty concerned during COVID that, wait a minute, that 500 million next year is going to be 425 in inflation adjusted terms. And this is terrible. Run that for 10 years and we will have lost 90+% of the spending capacity and the reserve capacity of the company. Yep. And so I think he was holed up, chatting with a friend because travel was difficult. And Eric Weiss, who is a fund manager, you've probably spoken to him at times.
Yes, been a guest, yes.
He suggested, that they were looking about anything, like could buy real estate, could buy gold. Public companies can't necessarily buy some types of assets. Eric Weiss said, well, what about Bitcoin? So then they went down the Bitcoin rabbit hole. And then, Saylor personally bought Bitcoin and went through the process of getting the company into it, which was kind of elaborate. I think they offered, a kind of buyback offer. Like this is a pretty dramatic strategy shift of the company, that they offered to buy back the shares at a favorable price for anybody who didn't want to, participate in that. And so they got a bit of shares bought back, and then I don't know, like 275 million, something like that. They immediately bought Bitcoin with, and he went on the financial news shows to explain what he did and why he did it.
Right.
And I watched that with interest, and I had the expectation that you'd see him on the financial review shows for a couple of days, and that would be it. He'd go back to his, managing his strategy business, but that was really not what happened. And then they started buying more. So they kept doubling down, right? They take on corporate bonds and then more corporate bonds, and then the price fell a bit and they bought more corporate bonds, the price fell some more. They took a Bitcoin collateralized Silvergate loan, and they just, you'd think they got to be tapped out, and they just kept going, right? Mm-hmm. So high conviction, I thought, was sort of encouraging for other companies, right? That, it's like, Boeing makes a new aircraft, and to demonstrate confidence, the management team goes on the maiden flight, right? So it's kind of like that. He's out on a bridge, jumping up and down, going at it in a fast-paced way where people keep being surprised that they found a way to do more, right? So that was kind of captivating. And so somewhere in that, once they were repeat buyers and they're then starting to try and encourage other companies to follow, I got into that thing I mentioned, which is actually, this is pretty good. It's a good use case for companies that didn't have the concept articulated at the time, but the way I came to think about it more recently is Bitcoin's the hurdle rate, which means if you're in saving and investing, if you're a fund manager, like a hedge fund manager, sometimes you're collecting a management fee, but the bigger part of the compensation is the success fee or the carry. And that is, how much you make. But if it's some kind of fixed income type of product, people don't want to pay you a success fee in percentage terms on the US Treasury rate, because they can get that at what's considered a zero risk, right?
Right.
So they'll often agree to put a hurdle rate, which is something you could get all day long, low risk, and subtract that. So, so typically the hurdle rate is going to be based on the US Treasury rate or something. But with Bitcoin, I'm thinking, well, no, that's incorrect. Bitcoin's the hurdle rate. If you're doing any other form of investing that's long term, if you can't outperform Bitcoin, you should stop and buy Bitcoin. And then what does that mean for a company? Well, it means you should put your cash reserves in Bitcoin, because you're not going to, it's very, very hard. Very few companies over the long term have even come close to keeping up with Bitcoin, because the historic rise has been so meteoric, and we all know the metrics of the history, right? Best performing asset class of the last 15 years, 10 years, 5 years, pick anything you want, right?
In 2020, one company flipped the script, ditching traditional cash strategies and going all in on Bitcoin. What started as a defensive move against inflation turned into a full-blown conviction play. Buy billions, issue bonds, take loans, buy more. They didn't wait for validation. They became the blueprint. Years later, the message is simple. If your savings can't outperform Bitcoin, why bother? The bar has moved. Bitcoin isn't the alternative anymore. It's the standard. Everything else is just trying to catch up. Some see Bitcoin treasury companies as a gimmick, but there's strategy behind the suits. These firms use corporate tools, loans, bonds, share issuance to acquire Bitcoin faster than most individuals ever could. It's not about replacing self-custody. It's about scale. The skepticism is real, especially after past blow-ups, but the logic is simple. If you can back into a position where the company's Bitcoin per share outpaces your cost, you're essentially holding turbocharged Bitcoin without managing any of the complexity yourself. Let's watch more clips from his interview.
So the concept there is, well, if I buy it at, let's say, 3 times multiple, how risky is that? And one way to look at how risky is that is how long will it take at the historic rate they've been accumulating Bitcoin per share until that risk is paid for. And the point that risk is paid for is when the Bitcoin per share is increased by 3 times, so that you have paid 1 Bitcoin for the number of shares that holds 1 Bitcoin collectively. And so I felt like if you could get yourself with a holding that you'd effectively paid 1 times MNAV for, because they'd continue to accumulate. Of course, your risk is that the MNAV decays. That just the past is not necessarily a predictor of the future. But if you could get to that point, then it's a very interesting position to hold, because it's like an actively managed Bitcoin, right? If you got yourself back to the point that you paid 1 Bitcoin for this Bitcoin, and they're continuing to add Bitcoin, then they're working for you, and you can just be a long-term holder in it, right? So then, with that viewpoint, and I found that at that time, Metaplanet's months to cover, how many months it would take for that to be the case, was only 5 months. And the comparison for MicroStrategy was 18 months, because the MNAV was lower. And so that made me a bit more comfortable with the risk perception. So I bought more at that price. So that is, some of the context. And then, when it comes to the prices correcting, I think the question is, are they still able to increase Bitcoin per share? Are the strategies they have access to, do they continue to work when the MNAV is lower? And it depends what they're doing, right?
Right.
Then, you can just wait, right? I mean, if you can get to that 1 times position, then you don't really worry about it. You're more of a hold, the Bitcoin hodl mentality, and you've actively managed Bitcoin. So I was kind of looking at it from that perspective.
What do you say to those people that look at the treasury companies and they hate what's happening and they feel like it's somehow anti-Bitcoin?
Right. Yeah. I mean, I think there's a few factors there. One is it's a novel new strategy for a public or private company, right? To use the capital raising advantages of a company structure over what an individual can do easily, right? I mean, if you think about, one way to think about, and I think about it, if whether you want to invest in a treasury company, some people's reaction will be, well, I can do that myself. I used an example on a panel with Michael Saylor and Eric Lizette in Prague that, let's say you have a friend who has a dental practice, maybe it's, worth $1 million because of its annual turnover. It's a stable business. People always want dental work. And he tells you he's gone to the bank and he's got $1 million loan. Would you like to buy 10% of his company? And then he says, well, I don't want, 100,000, 10%. I want 110,000. And you're like, oh, that's greedy. But then you do the analysis and you realize he's got much better credit terms because he's got an operating business and he's got a lower interest rate. Maybe you don't have the collateral to even get the loan, or if you don't, or you have the loan is expensive because it's under collateralized. And so you do the sums and you realize that it's win-win. He gets a premium and you get a premium. So I think with that, you've basically proved ab initio for yourself that Treasury companies should come on a premium because you just did a reasoned exercise of why it could make sense to invest in a private company rather than trying to do it yourself. Now, of course, if you've got things you can borrow against, like unmortgaged real estate or something, maybe you could do it yourself too, right? So it just depends. But I think that's the starting logic. The other point is that there's something novel about them, right? It's a novel use for a company. And so people from a traditional private company or public company financing perspective are still getting to grips with how that works. You get skeptics from the professional and interest from professional and sole traders that they find it confusing or still getting to grips with it. And then Bitcoiners too, right? A lot of Bitcoiners are not necessarily traders or investors. They bought Bitcoin, the asset class, and they want a dollar cost average or buy and hold. And that's proved to be an extremely successful and low risk way to participate in Bitcoin, given the volatility. So they are skeptical about anything that has a risk reward trade off, because there have been a lot of things that have gone wrong with Bitcoin related investment schemes, which we saw in the last bear market where half a dozen companies suffered, like hedge funds and things, and lending programs, exchanges and so forth, suffered like contagion and bankruptcies. And so people are rightly, concerned about any risk reward trade-offs, that they want to understand it. And if the professional investors have trouble understanding it, then somebody who's not a trader is going to have even more trouble understanding it, because there's a bunch of novel concepts in how public companies work, different share classes, the ATMs, the whole thing, right? It's complicated. Yeah. So you get people who are skeptical. And then I think the other thing is, some people have a kind of, they don't like the banks or something, right? And so they're suspicious of people that wear suits to work and people that are operating companies, big companies, things like that. Whereas for me, with the cypherpunks list, I was actually, a lot of people in that discussion are like Austrian economic outlooks. They are anarcho-capitalists, right? So they want a very free market. They want minimized or no government, but they believe in, capitalism. And at least to my perspective, capital formation, public and private companies are a huge part of what, got humanity to the current state of, standard living, product and services, because you can't build advanced things. I mean, think about building, an Airbus A380 or something that costs billions to build, right? You can't do it without a company. And ultimately, my view is there's nothing that suspicious about a company. It's just a group of people with a shared enterprise, right?
The U.S. just handed Bitcoin treasury companies a powerful win, and it might reshape corporate finance as we know it. In new guidance released by the Treasury Department and IRS, unrealized crypto gains are no longer counted toward the Corporate Alternative Minimum Tax, CAMT. That means firms holding massive Bitcoin positions, like Strategy Incorporated, are now shielded from billions in paper tax liabilities. This isn't just a technical tax tweak. It removes one of the biggest roadblocks standing between institutional money and Bitcoin adoption. And it couldn't have come at a better time. With Bitcoin pushing past $118,000 and momentum building from every direction, rate cut bets, ETF inflows, and dwindling sell pressure, corporate adoption is about to accelerate. The fears that companies would be punished for merely holding Bitcoin on their balance sheet? Gone. Now they can lean in, unburdened, and double down on what early movers like Strategy pioneered. Adam Back once described these companies as actively managed Bitcoin positions, vehicles that let everyday investors gain exposure to Bitcoin through traditional markets without the operational burden of custody or risk management. This new IRS clarification only strengthens that argument. It gives these firms clarity, removes regulatory fog, and sets a new precedent. Holding Bitcoin as a corporate reserve isn't risky, it's now structurally smarter. For firms navigating a world of inflation and declining fiat trust, Bitcoin is no longer just an edge play, it's becoming the benchmark. And thanks to this ruling, that shift just got a huge tailwind. As we wrap up, let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.